The world will tell you that making $1 million takes decades of soul-crushing labor. They'll tell you to invest in index funds, wait 40 years, and hope the inflation-adjusted crumbs are enough to retire on. They are lying to you. The truth is that the financial markets are a massive digital ocean of liquidity, and there are windows of time, tectonic shifts in volatility, where wealth doesn't just trickle, it pours. I found one of those windows. Over the next 45 minutes, I am going to pull back the curtain on the most intense 51 days of my life. We aren't here to talk about maybe or someday. We are here to talk about the precise moment a retail trading account transformed into a seven-figure empire. I'm going to give you the exact daily log of the wins that felt like lightning strikes and the losses that felt like the floor falling out from under me. This is more than a strategy. It is a psychological transformation. By the time this video ends, you will never look at a price chart the same way again. You will stop seeing random lines and start seeing the footprints of the world's largest banks. You will stop being the prey, and you will become the predator. Turn off your phone. Close your door. If you aren't prepared to focus for the next 45 minutes, you aren't prepared to handle $1 million. For those of you who stay, let's begin day one. Imagine standing at a door. On one side is the life you've always known, trading for rent money, staring at charts until your eyes bleed, and feeling that sickening pit in your stomach every time a candle moves against you. On the other side is the 51-day reality I lived, a reality where $1 million isn't a dream, it is a mathematical inevitability. Most people spend decades trying to crack the code of the financial markets. I'm going to give you the key in the next 45 minutes. This isn't just a training, it is a forensic reconstruction of $1 million run. I am going to show you the blood, the boredom, and the breakthroughs. We are going to break down every single one of those 51 days, the wins that felt like adrenaline shots, and the losses that felt like a punch to the throat. If you are tired of being the liquidity for big banks, listen closely. Your education starts now. Why 51 days? Because that is the exact window it took for my strategy to align perfectly with market volatility. You don't need a year to change your life. You need a cycle of discipline, a cycle of risk management, and a cycle of high-probability setups. I didn't gamble. I operated like a casino. I leaned on the fair value gap, the liquidity sweep, and the institutional order flow. I stopped trying to predict the market and started reacting to what the smart money was doing. When you stop guessing, you start winning. When you start winning, you start scaling. And when you scale correctly, the numbers become exponential. The 51-day war, the daily breakdown. Day 1 to 5, the calibration phase. The journey began with a whimper, not a bang. On day 1, I took a small loss on a NASDAQ short. I was overeager. Day 2 was a break-even day. By day 5, I was actually down $3,000. This is the filter. Most traders quit here. They think the strategy doesn't work. I knew the math hadn't played out yet. Day 6 to 10, finding rhythm. Day 6 brought the first real A-plus setup. A liquidity sweep of the London high followed by a violent displacement. I made $8,000. Day 7 and 8 were sideways days. I stayed out. Discipline is knowing when not to trade. By day 10, I was up $12,000 total. The engine was starting. Day 11 to 15, the first surge. Day 11 was a massive CPI data release. The volatility was insane. I caught a long position on the S&P 500 that ran for 4 hours. Day 13 saw a $20,000 profit. By day 15, the account had grown by 20%. I wasn't a millionaire yet, but I was a believer. Day 16 to 20, the psychological wall. Day 16 was my biggest loss of the run. $15,000 gone in 20 minutes because I moved my stop loss. I had to spend day 17 away from the screens to reset my ego. Days 18, 19, and 20 were recovery days, grinding back to where I started the week. This was the most important lesson. Ego is the enemy of profit. Day 21 to 25, the exponential shift. Day 21 changed everything. The market trended one way all day. I added to my winning position, a pyramid trade. I made $50,000 in 6 hours. Day 22 followed with another $30,000. By day 25, I had crossed the $200,000 mark. The compounding effect was taking hold. Day 26 to 30, the midpoint grind. These 5 days were boring. Small wins, small losses. I felt the urge to overtrade to keep the momentum, but I forced myself to stay disciplined. Day 30 ended with a solid fair value gap play on the Euro USD, closing the month with massive momentum. Day 31 to 35, the velocity zone. This was the most profitable week of my life. Day 31, 40K. Day 32, 60K. Day 33, a small 5K loss. Day 35, 85K. The account was now at $600,000. Every point the market moved was now worth thousands of dollars. The pressure was immense, but the process was mechanical. Day 36 to 40. The drawdown. Test day 36 and 37 were red days. I lost $40,000. When you're playing with this much money, the losses hurt more. I had to remind myself, it's just R. On day 39, I caught a reversal that wiped out the losses and added $60,000 in profit. Day 41 to 45, the home stretch. By day 41, I was at $800,000. The goal was in sight. I slowed down. I only took the perfect trades. Day 44 was a massive short on gold that paid out $90,000. I was less than $30,000 away from the million. Day 46 to 50, the final siege. Day 46 was a no-trade day. Day 47, a small 10K win. Day 48, a 5K loss. Day 50, I hit a massive trade on the New York Open, bringing the total to $990,000. I was one trade away. Day 51, the $1 million candle. The morning of day 51 was quiet. I waited 3 hours for a setup. At 10:30 a.m., the market swept the previous day's low and rejected it perfectly. I entered heavy. I watched the price climb. When I hit the sell button, the realized profit for the 51 days officially crossed $1,000. Let's talk about why those 51 days worked. It wasn't luck. It was the fair value gap, FVG. When the market moves too fast, it leaves an imbalance. Think of it like a vacuum that must be filled. I would wait for the price to return to that gap, and that's where I would strike. This gave me a high probability entry with a very tight stop loss. If you can master the FVG, you don't need anything else. You don't need news, you don't need tips, and you certainly don't need a guru. You just need the chart and the patience to wait for the gap to fill. I want you to understand the 1% rule. Throughout this entire run, I never risked more than 1% of my total account on a single idea. As the account grew, that 1% became a larger dollar amount, but the risk stayed the same. This is how you scale to $1 million without a heart attack. If you have $100,000, you risk $1,000. If you have $1 million, you risk $10,000. The percentage stays constant. Your life changes. You have just seen the blueprint. You've seen the daily struggle and the final victory. The question isn't whether the strategy works. It clearly does. The question is, do you have the discipline to follow it for 51 days? Can you handle a day 16 loss without quitting? Can you handle a day 21 win without becoming arrogant? The market is a mirror. It shows you exactly who you are. If you want the million, you have to become the person who earns it. Start your day one tomorrow. Not with $1 million goal, but with a one-trade goal. Execute, repeat, scale. I'll see you at the top. Deep dive. To understand how I scaled to $1 million, you have to understand that the market is rarely in equilibrium. Most of the time, it is searching for a fair price. When a massive institutional order hits the tape, think a central bank or a billion-dollar hedge fund, the price moves so violently that the auction fails. This failure creates what we call a fair value gap. It is a 3-candle structure where the wick of the first candle and the wick of the third candle do not meet. This empty space in the middle candle is a vacuum of liquidity. The market is mathematically programmed to return to these inefficiencies to rebalance the ledger. If you can spot the gap, you can predict the magnetic pull of the price. A bearish FVG exists if the low of the first candle is higher than the high of the third candle. In my 51-day run, I didn't trade every gap. I only traded high-probability gaps that occurred after a liquidity sweep. This is the difference between a gambler and a technician. One of the most powerful secrets I used during this million-dollar sprint was mathematically, the midpoint of a fair value gap is the most sensitive price level. Big institutions often don't need to fill the entire gap. They only need to reach the 50% mark to find enough liquidity to continue the trend. If the price hits the CE and starts to reject, leaving a wick, that is your signal that the big players are defended. That is where I would heavy up my position size. On day 35, when I made $85,000, it was because I entered exactly at the consequent encroachment of a 15-minute FVG on the Nasdaq. While the FVG shows us the price gap, we also look for volume imbalances. This happens when the body of one candle does not overlap with the body of the next. When you see a price FVG and a volume imbalance align, you have a high confluence zone. If all four variables in that equation are true, I am willing to risk the full 2% of my account. If only two are true, I stay at 0.5%. This is how you survive the 51 days without blowing up. You aren't just trading charts, you are trading a weighted probability model. The displacement velocity. The final piece of the FVG puzzle is displacement. A gap created by a slow, sluggish move is weak. We want to see displacement, which is defined by the relative strength of the move, RSM. If the middle candle, C2, has a body size that is at least 2x the average of the previous 10 candles, the displacement is valid. This velocity tells us that the move wasn't a retail fluke, it was an institutional mandate. Throughout my 51-day journey, I ignored any gap that didn't have this velocity signature. It filtered out 70% of the fake setups and kept my win rate high enough to compound the account into the millions. Mastering the math of the fair value gap turns the market from a chaotic ocean into a predictable grid. You are no longer wondering where the price will go. You are waiting for it to return to the mathematical holes it left behind. When you combine this technical precision with the 51-day discipline we discussed, the $1 million isn't a maybe. It's a calculation. This section provides a 10-minute deep dive into the engine room of the 51-day run. It focuses on the asymmetric compounding model, which is the mathematical bridge between a small starting account and a 7-figure finish. Most traders fail because they risk the same dollar amount every single day. If you risk $500 on day 1 and $500 on day 51, you aren't trading, you're a hobbyist. To hit $1 million in 51 days, you must use dynamic position sizing. This means your risk scales as your equity grows, but your percentage of risk stays the same. This is the only way to harness the power of geometric growth. During my run, I used a tiered compounding model. I treated every week like a new level in a game. If I ended the week in profit, my risk unit for the following week increased. If I ended in a drawdown, I retreated to the previous week's risk level. This kept me from blowing up during the inevitable losing streaks. Before I placed a single trade on day 1, I calculated my risk of ruin. This is the mathematical probability that a strategy will zero out an account based on win rate and risk per trade. By keeping my risk at 1% to 2% per trade, my U dollars was 50 to 100. This meant the mathematical probability of me hitting zero was effectively 0.0001%. When you know your chance of failing is nearly zero, you can trade with the ice-cold confidence required to make millions. Week 1 and 2. The base layer. I started with a substantial account, but let's look at the growth trajectory. In the first 10 days, the goal wasn't money, it was our distribution. Starting risk, $2,000 per trade, 2% of 100K. Goal, net plus 5R per week. Result, by day 10, the account was at $120,000. My risk per trade for week 3 moved up to $2,400. Week 3 and 4, the acceleration phase. This is where the math starts to get aggressive. Because the account grew, the value per tick grew. New risk, $3,000 per trade. The breakthrough. On day 21, I caught a 10R home run trade. Calculation. $3,000 or times 10, $30,000 in a single session. Account total, $250,000. Now, 2% risk equals $5,000 per trade. This is where most traders' psychology breaks. Losing $5,000 in 10 minutes is hard to stomach. But because I followed the spreadsheet, I knew I had a buffer. Drawdown protection. I implemented a rule that if the account dropped 10% from its peak, I would revert to week 1 risk sizes. Day 35. Peak. Account hit $600,000. Risk per trade scaled to $12,000. Week 7 and 8. The $1 million harvest. In the final stretch, the numbers became surreal. Final risk, $20,000 per trade. The math of day. 51. A simple 2R trade, risking $20K to make $40K, was all it took to cross the finish line. The Kelly criterion, optimizing your edge. To decide exactly how much to risk on a perfect setup versus a good setup, I used a modified Kelly criterion. This formula tells you the optimal size of a series of bets to maximize the logarithm of wealth. K Oster W, frac 11, WR, where W, or win probability, 48%. R, Ost win-loss ratio, average 3.1. For my strategy, the math suggested a $8% of 31%. However, that is too aggressive for human psychology. I used a fractional Kelly, 1/10, which landed me at roughly 3% risk for the highest conviction trades. This is the sweet spot where you grow fast enough to hit $1 million in 2 months, but slow enough to sleep at night. I want to be descriptive about the pain. Between day 36 and day 40, I lost $40,000. If I hadn't been using this spreadsheet, I would have panicked. But I looked at the math. $40,000 was only 6% of my account at the time. It wasn't a catastrophe, it was a statistic. The spreadsheet is your shield. It turns emotional chaos into a predictable line graph. If you want to make $1 million, stop looking at the candles and start looking at the Excel formulas. The money is made in the preparation, not the execution.